Think about this for a second. Every April, tens of millions of Americans sit down at a kitchen table, pull out a stack of forms, stare at a screen full of boxes, and spend hours calculating exactly how much of their income they owe the federal government. Some hire professionals, some use software, some dread it for weeks and still end up filing at 11:59 on the last possible night. The whole ritual has become so deeply embedded in American life that most people treat it like a force of nature, like death, like gravity. You work, you earn, the government takes a cut. That's just how it works. That's how it has always worked. Except, here's the thing. For most of American history, that's not how it worked at all. The federal income tax, the one you file every spring, the one that funds the military and the highways and the bureaucracy and Social Security and Medicare and every program the federal government runs, it didn't exist until 1913. 1913. That's less than 115 years ago. There are buildings standing in Europe older than the American income tax. There are families that have been farming the same land for longer than the income tax has been the law of this land. And before 1913, the federal government somehow still managed to exist. It funded wars. It built infrastructure. It paid soldiers and diplomats and bureaucrats. It presided over the most rapidly expanding economy the world had ever seen, all without taking a single dollar directly from anyone's paycheck. So the question has to be asked, if there was no income tax for the first 124 years of this country's existence, where did the money come from? How did the federal government pay for everything? And what had to happen? What had to go so fundamentally, so visibly wrong, that Congress and the states ultimately decided to amend the Constitution itself and permanently alter the relationship between American citizens and their government? To answer that, you have to go back. Way back. Not just to 1913, but to the very beginning. Because the story of how America came to tax income is really a story about power, about who bears the burden of funding a society, about a tension between the wealthy and the working class that has defined this country since its founding, and about one of the most consequential shifts in the relationship between the American citizen and the American state in the entire history of the Republic. Let's start at the very beginning. When the United States declared its independence from Britain in 1776, it inherited a profound and immediate problem. Governments need money. They need money to raise armies, pay officials, build things, and maintain order. Every government in history has needed money, and every government in history has had to figure out how to get it. The question of where that money comes from, who pays, and how much, that is one of the oldest and most contentious questions in political life. For the founders of the United States, it was an especially charged question, because the entire revolution had been fought, at least in part, over taxation. The rallying cry of no taxation without representation wasn't just a slogan. It was a statement of principle about the relationship between a government and the people it governed. The colonists hadn't objected to paying taxes per se. What they objected to was being taxed by a parliament in which they had no voice, no representation, and no recourse. And so, when the new nation wrote its founding documents, the question of taxation was handled with enormous care. The Constitution, ratified in 1788, gave Congress the power to lay and collect taxes, duties, imposts, and excises. But it also included a critical restriction. Any direct tax, meaning a tax levied directly on persons or their property, had to be apportioned among the states based on population. This apportionment clause would matter enormously later, but in the early years of the Republic, it was almost irrelevant. Because the federal government had no intention of taxing people's incomes. It had a simpler, more politically palatable solution: tariffs. A tariff is a tax on imported goods. When a ship from Britain arrives in New York Harbor carrying bolts of fabric, barrels of wine, or manufactured tools, the federal government charges the importer a percentage of the goods' value before allowing them into the country. That money flows directly into the federal treasury. And the tariff was a near-perfect revenue source for the early republic for several reasons. First, it was politically invisible. Ordinary Americans didn't sit down and write a check to the government. The tax was embedded in the price of imported goods, collected at the ports, invisible to the average consumer. Second, it didn't require a vast bureaucracy to administer. Station customs collectors at the major ports charge the merchants, Keep the money. Simple. Third, it served a double purpose. It raised revenue and it protected American manufacturers from foreign competition. An American textile mill couldn't compete on price with British factories that had been operating for a century. Slap a 30% tariff on British cloth, and suddenly American cloth looks a lot more attractive. The tariff was simultaneously a tax and an industrial policy. Two problems, one blunt instrument. The government's reliance on tariffs was almost total. In 1800, tariff revenue accounted for more than 90% of all federal income. In 1850, it still represented more than 90% of the federal budget. For the first 7 decades of the Republic, the United States government ran almost entirely on customs revenue. The idea of taxing a person's income directly, taxing what they earned rather than what they bought, was not just politically unpopular. To most Americans, it felt like a violation of something fundamental. Your earnings were yours. The government had no business reaching into your wages. There were also excise taxes, taxes on specific domestic goods. The very first Congress passed an excise tax on whiskey in 1791, and the backlash was immediate and ferocious. Western Pennsylvania farmers converted their grain into whiskey because it was easier to transport and sell than raw grain, and the whiskey tax hit them like a direct attack on their livelihood. They saw it as exactly the kind of oppressive taxation that had justified the revolution in the first place. In 1794, the protests turned violent. Armed men attacked federal tax collectors, burned buildings, and threatened to march on Pittsburgh. President George Washington, in one of the most dramatic moments of his presidency, personally led a militia force of nearly 13,000 men to suppress what became known as the Whiskey Rebellion. The first and only time a sitting American president rode into the field at the head of troops. The rebellion collapsed without a major battle. But the political lesson was loud and clear. Excise taxes on domestic goods were a minefield. Tariffs were far easier to manage. And so the government leaned on its customs revenue, mostly left domestic taxation alone, and the arrangement held for decades. For a while, it worked well enough. The country was growing. Immigration was bringing in labor. Trade was expanding. Tariff revenue grew alongside the economy. But there were deep structural problems lurking just beneath the surface. Problems that would eventually make the old system not just impractical, but morally untenable. Tariffs are what economists call regressive taxes. They fall harder on the poor than on the wealthy. Think about it this way. A wealthy merchant who imports fine European furniture pays the tariff on luxury goods. But a working-class family that buys imported fabric for clothing or imported sugar for their kitchen also pays the tariff embedded in those prices. And that tax represents a far larger share of their income than it does for the merchant. The wealthy man might spend 10% of his income on imported goods. The poor family might spend 50%. A uniform tariff rate hits the poor family 5 times as hard in relative terms. This built-in inequity was a constant source of political tension, and it sharpened dramatically as America industrialized and the gap between wealthy industrialists and the working poor widened into something that began to look less like a gap and more like an abyss. And then came the Civil War. And the Civil War changed everything. When Confederate forces fired on Fort Sumter in April of 1861, the United States government suddenly faced a financial crisis of an entirely different magnitude. Wars are extraordinarily expensive, and the Civil War was going to be the most expensive war in American history by an enormous margin. Raising, equipping, feeding, and paying the largest armies the Western Hemisphere had ever seen required money on a scale that tariff revenue simply could not provide. The math was brutal and unavoidable. Congress knew it needed a new source of funding, and it needed it fast. In August of 1861, just months after the war began, Congress passed the Revenue Act of 1861. And buried within that legislation was something entirely new in American history: the nation's first federal income tax. The rate was modest by modern standards, 3% on annual incomes above $800. In 1861, $800 was a substantial sum. Most ordinary working people earned far less, meaning the tax fell primarily on the affluent. But the principle had been established. The federal government could tax income directly. Congress had crossed a line that had seemed uncrossable just a year before. The following year, Congress went further. The Revenue Act of 1862 introduced graduated rates, a higher percentage on higher incomes, making it explicitly progressive. Incomes between $600 and $10,000 were taxed at 3%. Incomes above $10,000 were taxed at 5%. And the legislation created something else that would eventually become enormously significant: the Office of the Commissioner of Internal Revenue. For the first time in American history, there was a federal agency specifically tasked with collecting taxes on income, the distant ancestor of what we now call the IRS. It worked. The Civil War income tax raised hundreds of millions of dollars, helping to fund the Union war machine. By 1866, the income tax was generating $73 million a year, accounting for roughly a quarter of all federal revenue. But the tax had always been presented as a temporary wartime measure, and once the war ended, the political will to maintain it evaporated almost overnight. Rates were slashed repeatedly through the late 1860s. By 1872, Congress allowed the income tax to expire entirely, and just like that, it was gone. The country returned to its dependence on tariffs. The Office of Internal Revenue remained, pivoting its focus to excise taxes on alcohol and tobacco, but the income tax itself was dead. And for about 20 years, most Americans didn't miss it. The post-war economy boomed. The Transcontinental Railroad was completed in 1869. Industrialization accelerated at a pace that seemed to defy gravity. Steel production soared. Coal mines opened across Appalachia. Cities mushroomed in the Midwest. Tariff revenue grew alongside the growing economy and expanding trade volumes. But beneath the surface of all this prosperity, something was happening that would eventually make the old system untenable. The Gilded Age was producing wealth on a scale Americans had never seen, and concentrating it in the hands of a vanishingly small number of men. John D. Rockefeller's Standard Oil at its peak controlled roughly 90% of America's petroleum industry. Carnegie Steel produced more steel than the entire nation of Britain. Cornelius Vanderbilt controlled railroads stretching from New York to Chicago. J.P. Morgan's banking empire wielded influence over capital markets that no government agency could match. These were not merely successful businessmen. They were economic forces of nature, capable of shaping industries, governments, and entire regions of the country according to their will. And here is the critical point. Under the tariff-based system, these men paid essentially nothing in proportion to their wealth. They paid tariffs on imported goods like everyone else. They paid modest excise taxes on certain products. But their vast accumulations of stock wealth, their dividends, their capital gains, their income from monopolistic enterprises, none of that was taxed, not one penny. Meanwhile, the tariffs that funded the federal government were being paid disproportionately by working people, farmers, and small business owners. The system was fundamentally inverted. The more wealth you accumulated, the smaller your relative tax burden became. The less you had, the harder the system hit you. This became the central grievance of the populist movement that swept through rural America in the late 1880s and early 1890s. Farmers across the South and Midwest were being crushed. Railroad monopolies charged exorbitant freight rates to ship crops to market. Banks charged brutal interest rates on farm loans. Commodity prices were falling while the cost of everything they needed to buy was propped up by protective tariffs. All while a handful of men in New York and Pittsburgh and Chicago were becoming incomprehensibly rich, paying almost nothing into the system that protected their property and enforced their contracts. The Populist Party, founded in 1892, made the income tax a centerpiece of its platform. The logic was straightforward. Tax income at a graduated rate, and the wealthy pay more. Shift the burden of funding the government away from consumption taxes that hit the poor hardest, toward a levy on the income the rich were accumulating at a historic pace. It was a radical idea. It was also an enormously popular one. The first real legislative attempt to revive the income tax came in 1894. Congress passed the Wilson-Gorman Tariff Act, which included a provision for a 2% tax on personal incomes above $4,000 a year. In 1894, $4,000 was a genuinely substantial income. The tax would have applied to fewer than 1% of all Americans, the wealthiest households in the country. But it never took effect. In 1895, the Supreme Court of the United States struck it down. The case was Pollock versus Farmers Loan and Trust Company. The ruling was 5-4, one of the most contested decisions in the court's history. The majority held that an income tax constituted a direct tax within the meaning of the Constitution. And since direct taxes were required to be apportioned among the states by population, a flat national income tax was unconstitutional. The door was slammed shut. Any federal income tax would now require amending the Constitution itself. The dissenting justices were furious. Justice John Marshall Harlan called the ruling a disaster and predicted, correctly as it turned out, that it would ultimately be reversed. But it would take nearly 2 decades. The battle moved entirely into the political arena. For the next 15 years, the push to amend the Constitution and authorize a permanent federal income tax became one of the defining struggles of the progressive era. Theodore Roosevelt, who became president in 1901 following the assassination of William McKinley, was a complicated figure in this fight. A wealthy man from an aristocratic New York family, Roosevelt was nonetheless genuinely alarmed by the concentration of economic power in the hands of the great industrialists. He didn't want to destroy capitalism. He wanted to tame its worst excesses, to prevent the kind of runaway inequality that he believed would ultimately destabilize the republic. Roosevelt called for a graduated income tax and an inheritance tax in his 1906 State of the Union address. It was one of the most radical speeches by a sitting president up to that point in American history. His successor, William Howard Taft, was far more conservative by temperament, but even Taft eventually endorsed the idea of a constitutional amendment, calculating that sending the question to the states was safer and more durable than passing a law that would be immediately challenged in court and likely struck down again. In June of 1909, Congress voted to send the proposed 16th Amendment to the states for ratification. The text was brief, almost startlingly so. The Congress shall have power to lay and collect taxes on incomes, from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. 36 states were needed to ratify. The campaign was long and hard-fought. Wealthy interests poured money and political pressure into blocking ratification at every turn. But the tide of public sentiment had shifted too far and moved too fast. On February 3, 1913, Delaware became the 36th state to ratify the 16th Amendment. And with that, it became part of the Constitution. Permanently. The income tax was now constitutionally authorized for the first time in American history. Not as a wartime emergency. Not as a temporary fix. As a permanent feature of American governance, locked into the founding document of the Republic. Congress moved quickly. The Revenue Act of 1913 established the modern federal income tax within months of ratification. The initial rates were almost impossibly gentle by today's standards. Incomes above $3,000, roughly $90,000 in today's money, were taxed at 1%. A graduated surtax applied to higher incomes, reaching a maximum rate of just 6% on incomes above $500,000, or about $15 million in today's dollars. The tax applied to fewer than 1% of the population. Most working-class and middle-class Americans paid nothing at all. And for the first time, the tariff dropped from its position as the near-exclusive funding mechanism for the federal government. America now had 2 major revenue streams, and the balance between them was about to shift in ways the authors of the 16th Amendment could never have imagined. Because just a year later, the world went to war. World War I transformed the income tax from a modest symbolic measure into a genuine revenue engine almost overnight. The cost of modern industrial warfare was staggering beyond anything the previous century had known. The United States entered the conflict in April of 1917, and Congress immediately began cranking up rates. The Revenue Act of 1917 raised the top marginal rate from 15% to 67%. By 1918, the top rate had reached 77% on incomes above $1 million. The income tax had gone, in the space of 4 years, from a novelty affecting almost no one to the central funding mechanism for the most expensive war in human history. The number of Americans filing tax returns exploded. Fewer than 500,000 returns were filed in 1916. By 1920, that number had surged past 7 million, and the revenues were enormous. By 1918, income and estate taxes accounted for nearly 70% of all federal revenue, completely inverting the old order in which tariffs had reigned supreme for over a century. After the war, rates fell significantly. The Republican administrations of the 1920s slashed the top rate to 25% by 1925, arguing that lower taxes on the wealthy would spur investment and economic growth. But the income tax never went away. The machinery was in place. The habit of filing, calculating, paying, it was embedding itself into American life. And then came 1929, the stock market crash, the Great Depression, and the federal government's appetite for revenue expanded once again, enormously. By 1944, with World War II raging on two fronts and the survival of the democratic world hanging in the balance, the top marginal rate on income had climbed to 94%. 94% on income above $200,000. These were the rates that funded the most total war in human history. The aircraft, the tanks, the ships, the bombs, the logistics miracle of supplying millions of men across two oceans simultaneously. All of it funded, in enormous measure, by an income tax that had not existed 30 years earlier. And something else happened during World War II that would permanently change how ordinary Americans experienced taxation. In 1943, Congress introduced withholding, the system by which taxes are automatically deducted from your paycheck before you ever see the money. Before this, Americans paid their income taxes in a lump sum, quarterly or annually. The switch to withholding was sold as a wartime necessity, a faster and more reliable way to collect revenue. But it accomplished something far more subtle. By deducting taxes automatically at the source, withholding made the income tax psychologically invisible for most workers. The money was gone before it arrived. You never held it in your hands. You never felt yourself writing a check for hundreds or thousands of dollars to the Treasury. That psychological sleight of hand, more than any other single feature of the modern tax system, is what made the income tax politically durable in a way the old tariff system never quite managed to be. People complained about taxes. They always had and always will. But the withholding system meant that for most workers, the pain of taxation never felt as acute as it might have. The government took its share quietly, at the source, before you could hold it and feel its weight. But the story of the income tax is not simply a story about revenue. It is a story about who shapes the rules and who benefits from them. Because from the very beginning, the wealthy and the powerful worked methodically to carve out exceptions, deductions, loopholes, and special treatments that reduced their actual tax burden far below what the stated rates suggested. The deduction for mortgage interest, the preferential treatment of capital gains, the use of corporate structures to defer and minimize personal income, oil depletion allowances, accelerated depreciation schedules, charitable deduction strategies that preserved wealth while generating public credit. None of these were accidents. They were the result of decades of lobbying, legal creativity, and political influence by interests who benefited from keeping the effective tax rate on wealth far below the nominal rates posted in the law. By the 1950s, while the top marginal rate sat at 91%, the actual rate paid by the wealthiest Americans was dramatically lower, because virtually no one at the very top earned purely ordinary income. Their wealth came in the form of capital gains, corporate profits, trust distributions, and other forms that were taxed differently, or taxed later, or not taxed at all. The tax code, which had begun as 14 pages in 1913, had grown into a labyrinthine document tens of thousands of pages long. Each additional wrinkle represented some interest's successful effort to reduce its burden. Each new complexity created a new advantage for those who could afford sophisticated professional advice and a new disadvantage for those who could not. This is the deep irony at the heart of the American income tax. It was created by populists and progressives who wanted to make the wealthy pay their fair share. And for stretches of American history, it did exactly that. The enormous revenues generated during World War II and the post-war decades funded the GI Bill, the interstate highway system, NASA, and a social safety net that gave tens of millions of working-class Americans access to security they had never known. The post-war generation built the greatest middle class the world had ever seen, in part on the financial foundation that the income tax made possible. But the same concentrated wealth and political power that fought the income tax before 1913 didn't disappear after 1913. It simply redirected its energy. Instead of fighting to prevent the tax from existing, it worked to shape the tax once it existed. The battlefield changed. The war continued. And there is one more chapter that needs to be told. Because even as the income tax theoretically created a more equitable way to fund the government, the ways the federal government spent those revenues did not reach everyone equally. The GI Bill that sent millions of veterans to college and into suburban homes was functionally unavailable to most black veterans across large parts of the country. The FHA-insured mortgages that built the suburbs were systematically denied in black neighborhoods through the practice of redlining. The income tax funded a prosperity infrastructure, but the infrastructure was deliberately built with walls, and the communities locked outside those walls paid into the system like everyone else and received far less in return. Now let's step back and consider what all of this actually means in the sweep of American history. The income tax is often treated as a routine piece of bureaucracy, an annual nuisance, a stack of forms you'd rather not deal with. But in reality, it is one of the most radical transformations in the entire history of American governance. Before 1913, the federal government was deliberately small, its revenues constrained by what it could collect at the ports, its ambitions limited by the structural impossibility of tapping the wealth accumulating in private hands. After 1913, the government acquired the financial capacity to become something entirely different, to fight world wars, to build a social safety net, to fund scientific research, construct highways, and put men on the moon. The income tax made the modern American state possible. Without it, the New Deal could not have happened. Social Security could not have been funded. Medicare could not have been created. The military power that defined the American century could not have been sustained. Every institution, every program, every piece of infrastructure that Americans associate with the federal government of the 20th century rests, ultimately, on the foundation laid on February 3, 1913, when Delaware became the 36th state to ratify the 16th Amendment. And the system it replaced wasn't simply impractical at industrial scale. It was fundamentally unjust. It asked the most from those who had the least and the least from those who had the most. The income tax, at least in principle, reversed that relationship. It said that the burden of funding our shared institutions should scale with the ability to pay, that those who benefit most from the protections and opportunities a society provides should contribute most to maintaining it. That is a moral principle, not just a fiscal calculation. And the fight over that principle, over how progressive the tax system should be, over how much wealth is shielded from taxation, over who actually bears the burden of funding the common good, is as alive and as fiercely contested today as it was when populist farmers were marching and petitioning and demanding change in the 1890s. Think about that the next time you sit down with your W-2 and your calculator and your stack of forms. You're participating in a system that didn't exist 115 years ago. A system born from the crisis of industrialization and the moral outrage of ordinary people who watched a handful of men accumulate more wealth than any human beings in history, while the system that protected and enriched them asked almost nothing in return. A system that was ruled unconstitutional by the Supreme Court, then written into the Constitution by the American people themselves, then weaponized to fund 2 world wars, then shaped and reshaped over a century by an endless struggle over who should pay and how much. The income tax is not a natural law. It is a human invention, one of the most consequential inventions in the history of American governance. And like all human inventions, it reflects both the aspirations and the failures of the people who built it. It is a system that made extraordinary things possible, and a system that has been bent, gamed, and exploited by those with the power to do so, in ways its original architects would find deeply troubling. Understanding where it came from helps us understand what it was meant to do. and more importantly, whether we are actually still doing it. If you found this story as fascinating as I do, please consider subscribing to the channel. It really does make a difference, and I genuinely appreciate every single one of you who takes the time to do that. Also, if you haven't already, make sure you check out this video right here. I think you'll love it.